Hello and welcome to Martyn Lucas Investor. My name is Sensei and you're watching the Morning Forecast Breakfast Show. Welcome in everyone. Today we are watching the data come out potentially in about an hour's time, 55 minutes time. We should have data coming out. It's not confirmed yet, but it does look like jobless data will be coming out in about 55 minutes time. We'll have a timer on the screen as well for when that comes out. Thank you everyone for tuning in. We've also got lots of information about the new Fed governor, who he is, what he might do, and how he might cut rates, but mortgages will probably go up. And I'll explain that to you in this video as well, plus a lot more information. So let's get right into it. If you have just tuned in, thank you very much. We are covering the jobs data today as well. We got some very concerning figures yesterday. We might get some confirmation of that today, potentially. Let me just see. That timer is just slightly wrong, so I'll change that for you right now. I apologize. That will be at past, so that's the new timer there. So let's go over to our very own newsletter first, link in the description as always. A few of the top stories for today. Remember the morning forecast show, the morning newsletter. It's all about getting you ready for the day. So what's going on in the day? Well, we've done the research so you don't have to. We've got, let me just make sure we've got the, let me just refresh this. There we go. Yes, the new newsletter, jobs data and a 90% chance of a rate cut. We have now passed 90% on the Fed Watch tool, which is how we know if there's going to be a rate cut or not. The chances now is the market has priced in a 90% chance of a. Let me just make sure I've got this open. I hope nothing's going on. Now passed. Yeah, okay. It should be sensei now. Okay, I understand, guys. Sorry about yesterday. If it happens again today, I've got a backup and then I'll have to rewire my whole system. So if it does happen one more time, then I've got a backup system in place and then I have to rewire the system and work from the bottom up. But hopefully it won't. So 90% chance of rate cut. And if we go over to our top stories of today, we've got Salesforce beating on earnings, beating their expectations. We've got BlackRock CEO embracing Bitcoin. We've got Larry Fink literally admitting he was wrong. We've got the UK banks getting a boost. We've got altcoin ETFs. We've got even more altcoin ETFs coming. Chainlink, Polkadot. We've got some information there on how XRP was actually the most dominant there and holds the crown for 2025 out of all ETF launches. We're not even just talking crypto. Google overtakes OpenAI technology and Fed credibility faces tests. And that's why a lot of people are fearful right now. Economists, analysts, big investors, hedge funds are looking at who the next Fed could be, and they are very concerned. Some of you might say the new Fed is going to be great. Trump is going to elect someone who's just going to cut rates. But unfortunately, if you just cut rates and you lose market confidence, then what actually happens is mortgage rates goes up. Recession takes place. So we're going to take a look into all of that as well, so we can just educate you a bit more. I'm not saying that's 100% going to happen, but that is what the market's starting to price in as a real concern. But today's jobless claim, that's what we're covering today. One off glitch, I'm sure. Well, I hope so, but it has happened twice. So if it happens a third time, then we're going to have to restart systems from the ground up. Anyway, one big thing, today's jobless claims report is no longer routine. It is the final verdict on whether yesterday's shocking ADP contraction was a fluke or trend. Yesterday we covered the ADP, the private sector payroll data, and we were expecting maybe 5,000 jobs being created. That was way down from 40,000 jobs being created last time around. But actually, we didn't even get 5,000 jobs created. We got about 38,000 jobs lost, which is obviously a recession indicator. We don't like to see that. It boosted rate cut expectations. But at some point, if you lose too many jobs, then instead of being bullish because you're cutting rates, the market will take that as a recession hint. And today could be confirmation of that in about 50 minutes time. So with continuing claims already at multi-year highs, the labour market is flashing genuine warning signs of stagnation. Workers aren't just getting fired. They aren't getting rehired. They're not finding jobs. A print above 225,000. Remember, we've got the consensus over here. which is around 220,000. Previously was about 216,000. If we get above that, that will validate the calling narrative, cementing the case for a December rate cut and potentially sinking the dollar. So if we've got more people losing jobs, then of course the chance of a rate cut increases. However, if we get a more resilient number, less people are losing jobs, 220,000, that would muddy the waters, forcing the Fed to reconsider if the economy actually needs an immediate rescue. In a data-sparse environment caused by the shutdown, this signal metric carries disproportionate weight for the Fed's decision. Remember, we haven't been able to keep track of these numbers. We don't have a clear trend over the last month. So these numbers actually mean a lot more. Essentially, if it's too high, then the Fed was too late. If it's too low, then they don't need to cut rates and they can focus more on inflation. And if it's around consensus, then the market will be bullish. That's my opinion. Anyway, again, nothing I say is financial advice. We've got the fear and greed. We've seen it in extreme fear for the last week. It's now creeping back into fear. The stock market a bit less fearful than the crypto market. The number that matters today is an 85% cut probability. The current market pricing for a 25 basis point Federal Reserve cut in December, a hot joblessness claim print above 225,000 could push the certainty near 95%, while a significant beat below 215,000 could trim odds marginally. So we are expecting a rate cut. That is the consensus. No matter what the data is today, we are very confident we get a rate cut. It's just the probability of that. If it's above 225,000, then instead of being 90% chance of a rate cut, we're going to start pricing at a 95% plus chance. If it's lower than 215,000, maybe 150,000, 100,000, then that's when the expectation of a rate cut could drop significantly, maybe to 70, 60%. And the market might not like that. So yeah, if it's too low, the market won't like it. If it's too high, the market won't like it. If we're between 150,000 and 250,000, the market won't panic. We've got the market snapshot here. Everything's slightly down today. And then let's come on to our story about the Fed as well. We've got Larry Fink over here. Let me just play this for you.
When you're less fearful, like we had a trade agreement with China, you saw a shift downward. There is conversations this week that there may be some type of settlement in Ukraine. Bitcoin fell a little bit. So you own Bitcoin because you're frightened of your physical security. You own it because you're frightened of your financial security. The long-term fundamental reason you own it because of the debasement of financial assets because of deficits. And so to me, even the movement in the last week, and we've had a 20-25% drawdown, and this is the third time since IBIT was created, our ETF. And so you see these shifts, and they're actually pretty non-correlated shifts, and that's.
And let me play you this one as well. There's a full story on this, but this is funny. Remember, this is BlackRock CEO Larry Fink. We're still waiting for an XRP ETF from him, but this one is a bit funny as well.
Called crypto an index for money laundering. BlackRock
and thieves.
And thieves.
Yes.
Money laundering and thieves. Right. You now have the biggest Bitcoin ETF. So what happened here?
I have very strong views, but that doesn't mean I'm not wrong. By having strong views, you have to test yourself and ask yourself. And in my role, I see thousands of clients a year. I have governmental leaders, and we have these conversations. And my thought process always evolves. And this is a very glaring public example of a big shift in my opinion.
There we go. That's Larry Fink admitting he's wrong. And I did a piece here about that. Actually, I'll read it for you. So Larry Fink of BlackRock folds. I was wrong about Bitcoin. Larry Fink, CEO of BlackRock, managing about 12.5 trillion, just ate a humble pie live at the NYT Dealbook Summit. That's the New York Times. The most powerful man in finance explicitly admitted he was fundamentally wrong to label Bitcoin as an index of money laundering back in 2017. Today, he's not just apologizing, he's all in. His firm's Bitcoin ETF, IBIT, has rocketed to nearly 80 billion in assets, becoming their most profitable product line. This is them. Imagine this, BlackRock, who's been here for hundreds of years, thousands of ETFs, biggest player in the market. Their Bitcoin ETF, even though it's not their largest assets under management ETF, is their most profitable ETF. They make their most money out of their IBIT ETF. And they've only had it for a few years. So BlackRock now holds over 776,000 Bitcoin, roughly 3% of the total supply, proving its high conviction play and it's not just a PR stunt. This matters because Fink effectively set the acceptable. Yeah, this is why it actually matters to the market. So Larry Fink is effectively setting the bar. It's setting the acceptance risk parameters for global institutions. By rebranding Bitcoin from a criminal tool to what he now calls an asset of fear, he has framed it as insurance against geopolitical chaos and US debt instability, a concern he highlighted, noting 952 billion in US interest payments. This isn't about speculation anymore, it's about macro protection. With the Senate preparing to vote on the Clarity Act, Fink's timing gives political cover for pension funds and sovereign wealth funds to enter the market without repatriation risk. So what we're looking at here is Larry Fink setting the standard, especially going into that Clarity Act. But what I've said here in my insight was, here's a cynic's note. IBIT is now BlackRock's most profitable product line. Fink has to praise his own cash cow. If it's his most profitable ETF, do you think he'll come out and say, Bitcoin's awful, I think Bitcoin's used for money laundering, I hate it? Either way, Fink has to praise his own cash cow. But even so, it doesn't matter. Even so, motives are irrelevant here. His endorsement forces the rest of Wall Street to play catch up, legitimizing the asset class, whether he's a true believer or just loves the fees. Exactly. What I'm saying is, whether he's a true believer in Bitcoin and he loves it and he thinks it's great, or he just loves the fees and he's just coming out and pretending he likes Bitcoin. Either way, it doesn't matter. Why? Well, because he's the most influential man in finance, probably, and what he says means a lot, and others will follow suit because of what Larry does, whether he means or he doesn't mean it, which is obviously great for our crypto bags. But we can look deeper into it. Does Larry Fink actually like Bitcoin? I don't know. Larry Fink gave this interview 2 days ago. Yes. Is that a problem? USA 4547? I don't understand. Larry Fink is just selling his firm's ETF. That's all. A sales job. Yeah. But either way, it doesn't actually matter. Hi, Sensei, how are you doing? Hello, Daddy. Pascal, I'm doing well. How are you? Sorry, the volume was low. Okay, let's go over to our a couple more stories before we come on to the data release in about 40 minutes' time. The altcoin ETF floodgates are officially open. That's our next story here. The SEC ETF approval, Grayscale links ETF. So, we've got Grayscale now launched its Chainlink ETF. It launched a couple of days ago now. So pulling in and now we've got the numbers now. The numbers are, it pulled in 41 million in day one inflows, while Link surged 7% to $14. That's actually pretty good for an ETF. That's way more than Dogecoin. However, the real story is the disparity in institutional appetite across these new products. Canary Capital's XRP ETF, ticker symbol XRPC. Let me know in the chat if anyone owns any XRP ETFs or any crypto ETFs. It's still wearing the crown of 2025. It is still the biggest ETF launch of the year across everything, not just crypto. It's XRP's ETF, XRPC. It has smash records with 250 million in single day inflows on November the 13th. Contrast that with the utility-focused Bitwise Solana ETF that accumulated 651 million 6 October versus the Grayscale Dogecoin ETF, which landed with a thud. 1.4 million in volume. Dogecoin really did not perform well at all. And that really shows you Wall Street is clearly differentiating between infrastructure plays and meme coins. It is not time for meme coins. If we're in a bear market, it's definitely not time for meme coins. And what's going on, and what you can see, if it's on the stock market, you've probably got more institutional players, and you can take that data away. What's the biggest launch, and the ones that institutions were most interested in was XRP. What's the least, the lowest volume, the lowest inflows, it was Dogecoin. What was the second highest inflows? It was Solana. What's XRP? Utility. What's Solana? Utility. What's Dogecoin? Memes. I like Dogecoin. I own Dogecoin, but it's very clear that institutions are not looking at memes. They're looking at what can actually be a good asset. And that's why we can now see, especially when we're in a bear market, you need to go into quality. And the quality is Bitcoin, Ethereum, XRP, Solana, and I don't think there's many else that you can really put in that category. And you can see that everyone's fleeing to quality. Oh, we've got a few people holding XRP ETFs. Let's see who holds. Let's go to our chat. Motives are everything if you're investing in a product. Me, XRP ETF, and hold XRP on my exchange and my ledger. Daddy Pascal holds an ETF. Our market's going to go up today. If I knew, I would go all in on a long or a short, and I would become a millionaire overnight. Ganja says, I own XRP ETFs. Brilliant. I think only people in the US and Canada can, and Brazil, just not here in the UK. I got the XRPM. XRPM, which one's that one? XRPM. Oh, that's the XRP 3% monthly premium income ETF. What's that? XRPM 3% monthly premium income ETF. What the hell? I don't. I have not heard of it. Explain a bit in the chat what that's all about. Yep, I have a few XRP ETFs and a HBAR ETF. Oh, lovely, Corey Williams. Hit that like button. Yes, if you have just tuned in, it takes just 1 second, and I haven't asked you yet. So please just take 1 second to hit that like button. If you haven't subscribed yet, please do subscribe. We're covering the jobs data in about 37 minutes time. We're hoping to get it. There's no. Sorry. There's not actually any breaking. Let me go back here. Yeah, please do subscribe if you haven't done so already, and hit that like button as well. Okay, let's go back to the newsletter. I'll put the link in the live chat if you haven't got the newsletter yet. Backed by the Canary one. Oh, okay. Backed by the Canary one. Who said XRPM? It's backed by the Canary one. Woke up to XRP coming down, makes me nervous. I never get nervous. And that's because I'm very confident in my investment. I know exactly what my risk tolerance is. Let me just change this. Yeah, I know exactly what my risk tolerance is. Oh, why is that? 1 second. That's not working. That's annoying me. Don't worry about it. Okay. Oh, I understand. Okay, ignore me. Yeah. So yeah, I'm not worried. Whether it's down 20% in one day or up 20%, or it's gone to $10 and come back down to $2, I'm not worried. Why am I not worried? Because I'm prepared for every single scenario. If it goes down, it's very simple. My strategy is I've got certain levels, about 4 or 5 levels, I'll buy more XRP. If it goes up, I've got 4 or 5 levels, I'll sell XRP. If it goes sideways, I might accumulate XRP. But I haven't put in more than I can afford to lose. I'm not in leverage positions. I don't like to use leverage for long-term positions, especially in crypto, because you can get liquidated fast. If I wake up one day and I look on my app and I'm down 50% on XRP, I'll be very happy. Why? Well, because I've got all my limit orders set up. So I'd wake up and go, wow, brilliant. I've probably got some very good limit orders. And when XRP capitulates, it normally bounces back. So I'll probably have made money on that day. Every time we've had a big liquidation event for XRP, I've made money. Why? Well, because it liquidates and people buy it back up. And the buy orders I put in, whether it's a standard buy order or a leverage buy order, has made money. If you get worried about your investments, if you're worried about your XRP position, Bitcoin position, the most likely culprit is you don't understand what you're buying and you're not confident in it, which is very dangerous, because if it crashes, you'll probably sell, and if it pumps, you'll probably buy more because you're FOMO, or you've put in too much and it's it's too much of your portfolio and you've got other concerns, whether it's, I don't know, bills, life. Life's in the way, and you've put in too much, and that's the reason people get concerned. That's 90% of the reason why. So, so yeah, that's the main reason. So that's why I'm never worried, and that's why some people are. New York Stock Exchange, too boring now, being shorting corporate Euro stocks leveraged. Good luck to you. Basically trying to give a monthly return. Yeah, no, I understand. It's 3% a month they're trying to give, but there's definitely going to be some risk to that. I put in $1. I put orders at 150 when that black swan hits. Yeah, have those limit orders set up 150, $1, 80 cents, 50 cents. Even if you don't think it's going to happen, well, why not have the limit order set up? Because if it does happen, you can take advantage of it. And that's how I got so lucky. Well, I didn't get lucky because I planned for it. Remember October the 11th when we had that 50% correction? I got my buy orders at about $1.60 filled. The next second, or in the next 4 hours, it was back up to $2.20. That was a massive win just because I took 2 seconds to go on my phone and put in a limit order and not knowing if it's going to hit or not, but it did hit. So yeah, the crown is with XRP. We're going to come on to the data in a second. If you have just tuned in, hit that like button as well as subscribing. So we've got that OpenAI story, but the deep dive today is Fed credibility on the line, the asset risk pricing mechanism. So we've got asset potentially Trump has said he's chosen who is Fed, who he wants to be Fed chair. He hasn't confirmed who it is. The market's is pricing in the betting market, the poly market. We've got a pretty good idea that the odds are it's going to be Hassett. And what's Hassett all about? Well, and what does he represent and what's he doing to the markets? Well, the bond market, which is a massive, bigger than the stock market, Martyn was talking about this yesterday. People don't look at the bond market enough and don't understand it, so hopefully I'll explain it to you. The bond market has begun quietly pricing in a new structural risk, the politicization of the Federal Reserve. That is a real concern. The Fed is supposed to be independent. The Fed right now, most people would say, is independent. I know a lot of people in this chat would probably say that Jerome Powell is not independent and he's politicized and he's just trying to ruin Trump's credibility. But on the whole, if you look at the market on a whole and not... how do I explain it? If you look at how the market is pricing in, because at the end of the day, the market is the one that makes the final decision on if the Fed is independent or not. The market has been pricing in that the Fed has been independent. It has been independent for forever, essentially, for the last 4 years under Biden or whatever. What it's now starting to price in is that the Fed could potentially start not being independent and could have a real President Trump could have a real impact on what the Fed does and what Hassett does. And that's a real concern to the market because the market always wants the Fed to be independent and not have anything to do with politics. Just look at the data. So that's the new threat on the block. Following reports that Kevin Hassett is the front runner to replace Jerome Powell in 2026, sophisticated investors are looking beyond the immediate prospect of rate cuts. The narrative shifted decisively on December the 4th when Gregory Peters, the co-CIO of PGIM Fixed Income, publicly questioned Hassett's ability to deliver the aggressive easing President Trump demands. The core tension is mechanical. While Trump-aligned chair might wish to slash rates, they must navigate a consensus-driven Federal Open Market Committee, the FOMC. Peters suggests that Hassett, which is the Fed nominee, or that's who we think Trump is going to put forward, may lack the internal credibility to steer this committee. This is not me saying this is the market saying this. And also Peters saying this, but the market's now suggesting this as well. So Peters suggests that Hassett may lack the internal credibility to steer this committee, raising the risk of policy paralysis or a loss of inflation anchoring. And let me make this clear. This is not I'm not in the US. I don't have an opinion. Of course, it affects the money I have invested, but I'm not here to say Jerome Powell's amazing and Hassett is terrible, or Hassett's amazing and Jerome Powell's great, or Biden's great and Trump's bad. I'm not here really to give an opinion. I love seeing your guys' opinions, and I love seeing the passion in it, and I love that we are such a inclusive family here on the channel. Everyone has different opinions, but what we don't want to see, and this is where many people, even watching this show right now, they've got the wrong concept of rate cuts. Just because it's a great front page story, we've got more rate cuts, it doesn't actually mean mortgage rates go down. It doesn't actually mean cost of living goes down. It doesn't actually mean markets will rally. Just because of rate cuts, we will rally, or rate cuts, mortgage rates go down. It is not that simple. So please do not fall into the trap of just thinking rate cuts equals bull market, or rate cuts equals cost of living crisis to go away. That's not how it works. And I'll explain further in a second. So, yeah, where were we? Hassett may lack the internal credibility to steer this committee, raising the risk of policy paralysis or loss of inflation anchoring. Markets are not crashing, but they are adjusting. We're seeing a risk premium being built into the back end of sovereign bond curve. Investors are positioning for a scenario where Fed independence erodes, demanding higher compensation to hold long-term US debt. If we keep getting rate cuts, people will start getting concerned about the US government, the US economy, and they will demand higher returns on a 10-year bond. And what that essentially means, and I'll explain it further in a second, if we're getting lots of rate cuts and people will go, actually, that's too many rate cuts, the economy is not stable anymore, they will want more for their money by holding a 10-year yield, because they will start going, the US economy is too risky. If I'm going to buy your debt, you have to give me more returns. The 10-year yield will increase. And what that means is mortgage rates are based off 10-year yields, more than 1-year yields. So they're based off 10-year yields. And if the 10-year yield goes up because rates came down too quickly, mortgage rates go up. I'll explain that further in a second. And that's just if we just have rate cut after rate cut after rate cut, and the economy actually shouldn't have rate cuts. That's one of the results you can turn into, and that's what the market is slightly adjusting for now. We're going to come onto the jobs data in a second. I'm not saying we shouldn't have a rate cut. I think we should have a rate cut in December, or if not December, maybe January, and then really start to slow down. But that's just my thoughts. I'm not an economist, and I'm not the Fed chair. So, key drivers and analysis. Number one, the committee constraint versus the loyalist narrative. The primary friction point is a mismatch between political expectation and procedural reality. Kevin Hassett, and if you've just joined in, Kevin Hassett is looking. Trump has picked his Fed chair, but he hasn't told us yet. Market is saying it's probably Kevin Hassett. Anyway, Kevin Hassett, currently the director of the National Economic Council and a known dove, is viewed by the administration as a vehicle to deliver cheaper car loans and lower mortgage rates. However, the chair holds only 1 out of the 12 FOMC votes, so he can't just go off on his own and cut rates anyway. Gregory Peters argues that the bond market is discounting Hassett's potential impact because of the internal dynamics of the Fed. Peters notes explicitly that we do not know if Hassett has the credibility within the committee to drive consensus. So, essentially what we're saying here is Hassett, we are believing he would want to just cut, just because President Trump will tell him to cut. That's what everyone thinks about Hassett. However, the reason why the market isn't crashing or the bond yields aren't spiking or the 10-year dramatically is because the market is also looking at, can he do this? And they don't have confidence in Hassett to be able to do this because there's 12 members of the FOMC and he only owns 1 of the votes. So the market is saying, even though if it was all up to Hassett, we will be crashing right now and the 10-year bond yield will be all the way up here, because he doesn't have the final say and he's only 1 out of 12, they're lowering the risk and saying, actually, he can't even do it if he wants to anyway. This scenario, this creates a binary risk for investors. We've got 2 scenarios. And let me just read the comment. Market simple and stupid. It has been rate cut market rally every single time, says Songs for Space. Been trying to explain that to people in the chat for the past year, says Cedar Trees. Yes. Yeah, it's difficult because obviously the headline is rate cuts and everyone goes, oh, rate cuts, market rally, and mortgage rates come down. It's not as simple as that. Robinhood investors Guild put out last night that they think the Fed won't cut this time. Interesting. A new all-time high on SPY will happen. Yes, it will. Automotive packed. Ripple just kept moving forward and are always being relevant, says Sick Boy Customs. Sick Boy Customs says, personally, I think the first half of 2026 will be massive for XRP, given that the fact that that has been artificially low for many years. Ripple Bank ETFs, possibly BlackRock circulating supply of XRP. Yeah, we'll see. It's very hard to say what will happen in Q1 of 2026, but I'm long-term bullish anyway. So let's go back to the two scenarios we have at play. We've got scenario A, and we're coming on to the jobs data in about 24 minutes. Scenario A is Hassett respects... Hassett, I hope I'm saying his name right. I haven't heard anyone say his name yet. Hassett respects institutional norms, and policy data remains data dependent. That will be disappointing the political demand for rate cuts. So that's scenario A. Hassett comes in and actually he doesn't listen to Donald Trump and he just listens to data. Scenario B is Hassett comes in and he pushes for political cuts against the will of career central bankers. This leads to fractured voting, dissent, and confused signals to market. Investors are currently weighing the probability of scenario B. If the chair cannot unify the board, volatility in rate expectations will increase. And this is the potential problem we'll have in Q3, 4 of 2026, and potentially now people are starting to talk about this as well, so we might have an effect in the market. There's a few scenarios that can happen. Hassett comes in and he just looks at data. The board are all united. They're not political. They look at data and we continue in a bull market, or we have a slight recession and then we go into a bull market. Or we've got scenario B where he comes in and he's just keeps saying we need cuts, and then there's real instability within the Fed. And if people start seeing instability within the Fed, people not agreeing within the Fed, that will confuse the markets, that will show no confidence in the US markets, and that's when we have a real problem. The trust, trauma, and the financial dominance. This is one of the number 2 reasons. Remember Liz Truss in the UK? She came out with a budget. It looked great. I listened to the budget and I was like, amazing, tax cuts, this, that, other. But the market didn't like it. And why did the market not like it? Because it was too many cuts, too many, something that's not feasible. It sounds great, just like rate cuts sound great, but it's not feasible. The bond market's memory of the UK's 2022. Oh, God. So I've got something in the room. The UK's 2022 gilt crisis remains fresh. During private consultations with the US Treasury in November, major bond investors warned against a candidate who might enable unanchored fiscal expansion. One investor explicitly warned that the Treasury that no one wants to get trusted. Referring to market revolt against former UK Prime Minister Liz Truss. The anxiety drove the 10-year Treasury yield up modestly at about 2 to 3 basis points, following the Financial Times reported on these warnings. The concern is not about the Fed's fund rate, it's about fiscal dominance, a situation where central bank is forced to keep rates low to finance government spending, leading to runaway inflation. If the market perceives Hassett as a Trump stooge, bond vigilantes may sell the long end of the curve. This ironically drives up mortgage rates, even if Fed cuts the short-term policy rate. And we'll look at the infographic at the bottom. This is quite complicated stuff, and this is what economists will study and price in. But if you can read the newsletter and do your own research, put certain parts into AI and say, explain this for me, hopefully you'll get a better understanding if you don't know anything about the markets. However, if you've got a bit of an understanding, hopefully this is helping you understand what's going on. Number 3, we've got pricing the risk, the return of term premium. The most sophisticated signal currently flashing is the rise on term premium. This is the extra return investors demand to hold long-term bonds, comparing to rolling over short-term bonds. Peter highlights that the risk premium term premium is being built into the curve, not only in the US, but across all sovereign bond markets. Here is the fundamental mechanics driving current flows. Remember, all sorts of different bonds. You've got 1 year, 5 year, 10 year, 50 year, whatever. What do mortgages normally run off? 10 year. That's because you need to see where it is. And what are these bonds where it's essentially you buying US debt? The more risky the debt is, you will want to return more money. So you buy these bonds, and let's say the rate is 5%. So you're buying a 10-year bond, and because you're buying government debt, they're giving you some money. Every year, they're going to give you 5%. In fact, they give it to you every day, but it's spread across the year. They give you a 5% because that's what the rate is currently. If the US government is more risky, if their debt is more risky because they've got too much inflation, or they've got too much interest rate payments, or if they've got too much, they've got a chance of defaulting, the person who buys these bonds actually goes, well, you might actually default on these bonds. This is a bit more risky. I want more returns. So that's when it goes from 5% to 6% or 7%. And in fact, the yield is increasing. And how can the yield increase? It can increase even if rate cuts happen. Why? Well, because everyone goes, that's too many rate cuts. That's not right. That's not good for the economy. And then they go, we demand more money for our 10-year yields because the economy is in a worse shape. And then 10-year yields go up, mortgage rates go up. These are some of the things that can drive that. Is firstly the Fed independence doubts. Investors fear that the Fed will prioritize political goals over inflation. The inflation risk is if Fed cuts too early to please the White House, inflation could reignite. And the result would be investors refuse to lock in 10-year or 30-year rates without higher compensation. No one will buy these bonds because they'll go, why am I only buying these bonds for a 5% yield? And then it's forced to go up. This explains why long end yields remain sticky around 4%, even as prediction markets expected price in a higher probability of asset nomination. The market is effectively saying, we believe you'll cut short-term rates, but we demand higher yields to hold your long-term debt. I'm going to give you this infographic and I'll explain it all at the end as well. So structure, let me know if you're with me in the chat. Do you understand what I'm saying? Are you still with me? Structural implications, the bear steepener mechanics. The single most critical mechanism for investors to understand right now is the potential for a bear steepener in the yield curve. The normal easing cycle, a bull steepener, the Fed cut short-term rates, and long-term rates fall, but not fast. Everyone's making money on bonds. The Hassett-Peters dynamic suggests a different one, a more dangerous regime. If the Fed is viewed politically compromised, we could see short-term rates fall, long-term rates rise. Why would short-term rates fall? Because that's what the Fed is doing. Why would long-term rates rise? Well, because we're driven by inflation fears and the lack of trust in currency guardian. This is the bear steepener. It is toxic for the economy because it keeps borrowing costs high for businesses and homeowners, which is pegged to the 10-year high, even as the Fed claims to be easing. Peter notes that back end is quite fragile. This fragility is the market protecting itself against policy error. Sophisticated allocations are shifting out of long duration and fixed income to avoid being caught on the wrong side of a credibility crisis. For most people, it's fine. For example, Martyn, he's buying bonds, but he's not he's not locked into a 10-year yield. He's just on the side, waiting for a better time to buy the S&P 500. We'll hear more from Martyn shortly. And he's choosing to buy bonds on the side to generate some income. But we're talking about something bigger. We're talking about people not wanting to take out mortgages, not wanting to put in hundreds of millions of dollars into US debt, and they're not willing to put their money locked up for 10 years only for a 4% yield because they think they should get more. So here's the infographic to explain it all. Let me just go to the chat and see if everyone's understanding me. Are you still with me, guys? I used to have 6 next to my income. It's now back to 1. Good morning. We study with you, Sensei. Human being Liz. How do you plan to hold your cash over the crash? Cash, stables, or SGov? I'm not too worried, to be honest. for a 4% return or 3% return. With crypto, if you're investing in crypto, I mean, you're expecting much larger return. So I just like the simplicity of holding it in a stable coin, so I can have a limit order, and those are the limit orders I have in place. But aside from that, it's in gold, it's in silver, it's in a bank account. But yeah, I don't bother too much with. I mean, on trading 212, for example, you already get 3.5% or whatever on uninvested cash. But yeah, I mean, if I was trying to be a bit more sensible, I'll be holding probably some bonds. The XCL pre-sale same day. Human being Liz, I'm heading to Israel next week, visiting my dad because he doesn't feel so good. Zach Zay, I hope everything goes okay. I hope your father starts feeling better. Human being says, I'm so sorry. You were just there, right? That's what I read. I hope he feels better soon. I know how it is to yeah. Okay, yeah, we are wishing, we're sending thoughts and prayers to Zach Zate's dad. Let's go back here. No one responded to me to say, are they keeping up or not? Let's go over to the bond market mechanics. So let me just show you this one more time. So we've got two scenarios. Oh, let me go over here. Scenario A, the normal cut. This is great for the bull steepener. This is all that was happening during, was it last year? Was it last year, 2024? Yeah, end of 2023, all the way in 2024, when we just started just creeping up on the S&P 500. That's when Biden was in power and we had that really strong bull market. That was a bull steepener. The economy is safe, inflation is dead. That's what was the trend. It doesn't mean the economy is safe now and inflation is dead right now. We saw inflation going down and we saw the economy growing. Everyone buys bonds. The short term is going down. The rates are coming down, and also the long term is going down. The verdict is cheaper borrowing for everyone. Healthy rally. We might be there now, or we might be moving. We're sort of there now as well. Although this is ideal. The ideal thing is, and I don't even think it was during Biden and Jerome, this was exactly happening because there was other concerns. But ideally, we'll be in a situation where the economy looks safe and inflation is trending down and there's no other risks. And in that scenario, you've got short-term rates coming down. Why do short-term rates come down? Well, because the Fed is literally reducing rates, so the short-term rates do come down. Why do long-term rates come down? Well, long-term rates come down because people don't demand more money for holding their buying US debt for 10 years. Why? Well, because the economy is safe, inflation's under control. Everyone thinks everything's great. The US economy is great. I'm happy to earn only 3.5% for long term, or 3% in the long term. The verdict is there's cheaper borrowing for people buying cars in the short term, cheaper borrowing for people buying mortgages, cheaper borrowing for companies. But scenario B is the inflation risk, and this is the bear steepener. This is when investors think, ignore inflation, the dollar will lose value. So essentially, this is when, for example, Hassett comes in play and goes, let's just cut rates. What will happen there is people will buy anything that they're debt-wise they're buying will be very short-term. So they will have the short-term rates will go down. That's brilliant. That's great for maybe if you want to buy a car and pay it off in 2 years, or if you want to borrow money for a year or whatever. Short-term rates will go down. However, long-term rates will actually go up. Why do long-term rates go up? And when we talk long-term rates, that's mortgage rates. Any big companies trying to borrow money, their rates go up. Why? Well, because the mortgage rates rise despite Fed cut. It's an inflation fear because people want more money. They want to get a bigger yield because of the risk they're taking on. Because if rates come down too fast, inflation can get out of control. The US people won't be confident in the US government. The Fed independence will go down the toilet, and people will start saying, actually, the US is an absolute mess. If I'm going to buy US debt, I want more returns. And how do they get more returns? Well, the rate goes up on the long term. So that's hopefully that deep dive has maybe taught you something new or reiterated something new and told you about Hassett. But that's what we're entering now with potentially Hassett being the next Fed chair. We're going to get jobs data in about 10 minutes time, and that will confirm if we're going to get those rate cuts in next week. Either way, it does look like we're going to get rate cuts, but but what we're looking for is actually something a bit more concerning. Yesterday, with the ADP figures, they were quite bad and maybe recession territory. We want to see if the US government's data is the same. We might be getting it in 10 minutes. There is a chance we might not, but I'm pretty confident we will. So stay with us. I think Martyn will be going live in about 10 minutes, so you can even watch the data release with him, but I'll be live for 5 more minutes, then I'll be live 5 minutes extra, so I'll be live for another 15 minutes, and then we'll go to Martyn for analysis, but Martyn will be live in about 10 minutes as well. So you can decide who you see the data release with. Let's get ready for the data release and go over to your questions. Let's go over to Bloomberg.
125 citing potential for a good holiday season. Sticking with retail, Dollar General shares rising after earnings. The budget retailer boosting its full-year outlook as more consumers turn to discount options. Chuck Grom of Gordon Haskett has an accumulate on the stock with a price target of $115. Chuck joins us now for more. Chuck, just taking a step back.
We're talking about Dollar Tree, and I just want to bring up I was super bullish on this stock on this channel at $60. Double bottom, triple bottom, 3 opportunities to buy Dollar Tree at $60, and we hit our target of $120. That is 104%. That's doubling your money in less than a year. Congratulations to anyone who did buy Dollar Tree. There you go. There we go. That's why we love looking at charts and love buying things under value. Is anyone excited for when we start the portfolio challenge? I'm trying to do what Martyn did, 5,000 to where he is now. I'll be doing it live on the show. Let me know if you're excited about that.
Five below last night. So we'll see how things shake out.
Chuck, Emery was talking about this earlier. Is it good news or bad news that consumers are going to the discounters more significantly? Dollar General in particular, Dollar Tree, tends to indicate that people are trading down. Is this time different?
I think, everybody's talking about this K-shaped economy, and I think it's real. You saw Bloomingdale's last night at Macy's have really good numbers. And like you said, some of these dollar stores doing a little bit better tend to be an indicator of consumer stress. And I think we'll see that play out. The big thing that we're focused on is companies that can drive traffic. And the big difference between some of these low-end dollar stores is DG's traffic was up 2.5%. Dollar Tree's was actually down. Five Below last night was up 7%. So traffic is always an important barometer for a retailer's health, and that's what we're going to continue to be focused on.
Chuck, you're talking about this K-shaped consumer. So, okay, Blue Mercury and Bloomingdale's doing really well. Dollar Tree, Dollar General doing really well. What about those retailers in the middle? Are they doing well?
I think it's a jump ball. I think it's companies that are isolated on taking share individually, like a Kohl's or a Macy's. We're going to continue to monitor it. I think there's a lot of market share up for grabs, and at some point it's a zero-sum game. You see in off-price, right? You see TJX doing really well, Ross Stores doing really well, but Burl's struggling. So there's no really one-size-fits-all. It's all market share opportunities within each of these verticals.
When you talk about the hangover in January, what does that look like?
Well, that's an interesting question. That could be a lot of things. But I think it's going to be a slowdown in spending in January and into February. People are going to spend, they're going to build up the credit, and then they're going to have to pay that credit down. We've seen that's a historical pattern, and I think most retailers will take a really strong holiday for softness in the month of January. It's not a surprise to us. You are going to see some fiscal stimulus come in the form of better tax refunds as we move into the first quarter. That's going to be a very big impact in the front half of 2026. That should be a big tailwind for a lot of companies in our coverage universe.
Chuck, we're about 7 minutes away from getting jobless claims, and there's been this divergence where the consumer has held in. It's been a mixed season, but there has been some sign that they are absorbing costs and continuing to shop. And we've seen increasing weakness on the labor front from the retailers that you speak to and analyze. How much are they looking for efficiencies on cutting costs?
Yeah, we're sending prayers to
augmenting with
Zach's
technology in order to maintain their margins, maintain their profitability?
No doubt. I mean, if you look at what we're seeing across price increases this year.
Guys, if you just tuned in, we're literally 5 minutes away from jobs data. Please hit that like button and subscribe.
We're seeing at the consumer level, you're seeing a lot of efficiencies, and that's something that a lot of these companies learned 5 or 6 years ago coming out of COVID, how to think on their feet, how to be more efficient, and now we're starting to lay in artificial intelligence. We're seeing companies just being smarter across the board, whether it be how they're allocating labor in stores, how they're allocating
Initial
supply
jobless
chain
claims
costs,
coming out
just across
in
the board.
5
They're just
minutes.
getting smarter and being able to do it better. But to your point, there are some signs of consumer stress out there. You just referenced Kroger lowering their ID sale guide. Costco, a company who rarely misses on monthly comps, missed last night, and traffic was the issue. So it is tricky out there right now. It's not rosy. I think our macro survey work shows consumer is still very concerned about pricing. I mean, food prices are still up 25 to 30% year over year. It's going to be a very cold winter. We're going to start to hear about higher heating bills coming in, and that's going to be another factor that'll impact that hangover effect in January. So we think you have to be very selective. We're barbelled in our approach in terms of stock ratings. We'll continue to monitor things over the next few weeks.
Chuck Rahm, and hopefully we can continue to check in with you over the next few weeks. Chuck Rahm of Gordon Haskett, thanks so much for being with us. Right now, you are seeing that bifurcation. Dollar General shares on one hand doing better, and what you see coming out of Kroger is not so much. Speaking to the story about groceries.
Speaking to the story about groceries, that they are up, they are much higher. We saw the
Okay, so we're minutes away from the jobs data. Let me just reiterate what's there. If you always have the newsletter, well, you will never be behind. So let me give you the link for the newsletter right now. You get a 1-week free trial on the annual plan. There's a free plan. There's a monthly plan. There's a lifetime plan as well. So go and check it out. So what we're looking at right now is the jobless claims, initial jobless claims. Yesterday, we got the ADP numbers, and it was pretty bad. It's great for rate cuts because rate cuts are probably going to happen because of that data yesterday, but it's also bad in terms of recession. So, with continuing claims already at multi-year highs, the labour market is flashing genuine warning signs of stagnations. Workers aren't just getting fired, they aren't getting rehired. A print above 225,000. Remember, we are going to get this number over here. We will be refreshing here. Keep an eye on this line over here, which says initial jobless claims and initial jobless claims 4-week average. The consensus is sort of 220,000. If we get way above 225,000 or above 225,000, that would say actually we're losing a lot of jobs. Rate cuts are definitely going to happen, and if they're too high, then we'll start saying the Fed was way too late and a recession could be occurring. If we get a resilient number that's below 200,000, maybe 150,000, 100,000, where we say actually not many people lost their jobs, we don't need to cut rates and we should just keep rates higher for longer to combat inflation. That's what we're looking at here. So let's get ready for that. We are 2 minutes away. Let's get Bloomberg all up to speed, because this is a life hack for anyone. If I go over to this screen over here, we go here. You can see on the right hand side of the screen, if you go, I can't really show you. Yeah, it says playback speed. If you press playback speed, even on this stream right now, and if you're on a computer, you can press 4x. Even though you're live, if you press playback speed of 4 times, you will actually be even more live. You'll come straight up to where we are. So I've just done that with Bloomberg so we can have the most up-to-date numbers for you. 1 minute and a half to go. Here we go. So this is jobless claims. If you have just tuned in, it just takes 1 second. Hit that like button. Make sure you're subscribed. Sign up to the newsletter. The link is in the live chat. All of this is in the newsletter every single day. You get the top stories at a glance. Everything's going on. The one big thing, the fear and greed, the number that matters. We've got an 85% cut probability. If we get a hot jobless claims print above 225,000, that can put it towards 95% plus. While a significant beat could that means less jobs were lost, we could bring that probability back down to 80%. We've got all the top stories, Salesforce story, every top story. We've got Larry Fink saying who's wrong, and all the videos are embedded into it. We've got Bank of England. We've got the altcoin ETFs, why XRP and Solana are king, and how Dogecoin lost out and what that actually means. You've got the whole story of Fed credibility on the line. We've got the asset risk and what that all means, and how interest rate cuts could actually mean higher mortgages. You've got the chart of the day as well, the EVTL. So you've got everything in the newsletter every single day. Go and check it out. There's a free plan, there's a monthly plan, there's an annual plan, there's a lifetime plan. There's a plan for everyone. This gives you a 1 week free trial on the annual plan. Go and check it out. We are 35 seconds away. You know the numbers we want. We are prepared for this. I'm not actually trading this, but what I'm looking for is, are we entering a recession, and is this number also going to be the same as what we got yesterday about ADP? Is it going to be concerning? There is a slight chance we won't get this data, but I think we will. So let's see if we get it. Let's see if Bloomberg are covering this. They are still recovering from the shutdown, but I think we will get it. Here we go.
It feels a little bit like people are sitting there turning around their pencils without some of the key data points that we're used to getting. Markets basically flat across the board as
here we go, 191,000.
0.1% on the S&P. You are seeing yields just a touch higher, 4.09%.
That's not awful
on the 10-year, despite some
that's better than expected
overnight that actually did better.
Less jobs were lost. Rate cut expectations might go down slightly,
which is the key data that we get after what we got with Challenger, and they actually come in less than expected. They were expected to come in at 220,000. They came in at 191,000. It is down from what we saw last week, which was at 216,000. Now, for continuing claims, you also see a slight decline. So the people who actually were receiving unemployment benefits ticked lower to 1.939 million from 1.96 million. I know it's like parsing hairs. At the same time, in the right direction. This would indicate that the economy is not necessarily falling off the cliff. Bloomberg's Enda Curran joins us with more. Enda, what do we see here?
Well, it was a holiday-shortened week, Lisa, worth bearing in mind. But I think it's interesting to your point that the continuing claims also dipped a little bit. I mean, you can have the volatility in the headline number, but a lot of people have been arguing that the ongoing increase in the continuing claims...
I'll explain this in a second.
...weakening labour market. Nonetheless, the headline figures, taken with the Challenger data earlier on this morning, suggesting that layoffs, the pace of layoffs has maybe slowed, perhaps suggests maybe the jobs market isn't as bad as thought, or perhaps is even stabilising. But really, Lisa, the bigger picture, though, we have to remember here, even without the official data, of course, is that we've had the ADP, we've had those warnings from the Beige Book, and of course we have rolling headlines from companies that at the very least the labour market is softening. The question now is just how weak it is, and of course until we get a good run of official data...
This is what we expected, this is what we said. This is actually good, not bad.
It's kind of, as you would expect, a mixed picture. On one hand, it does seem like the Fed can cut rates come next week. At the same time, the degree to which they are able to cut rates going forward in question. You could see this. S&P futures now almost flat. NASDAQ futures down now 0.1%. Russell 2000 down 0.3%. The Y is in the bond space. 2s, 10s, and 30s. Yields higher, price down across the board, up 3 basis points at the front end. 3.51%. 10-year yields, similar type of move. It does seem like when you bleed this through the currency space, this is actually going to be a stronger dollar, at least for the moment, pausing some of the weakness that we have been seeing. And it does seem like this does put the Fed in a position maybe to cut next week. But after that, a lot of questions of how far they can go.
Well, that is a big question, Lisa, as you say. The markets have clearly decided the Fed will cut next week. We had some strong dovish signals towards the start of the blackout period, in particular the head of New York Fed, John Williams, of course, suggesting that perhaps there is enough there to get the Fed over the line for a rate cut. We don't know that. We know it's going to be somewhat of a close call. But to your point, whatever comes out of that decision next...
Okay, we've got enough from Bloomberg there. So, look, this is what we said. Then we get rid of the timer. The jobs data has just come out. It is stronger than expected. What do I mean by that? Does that mean we've got higher chance of a rate cut? Actually, no. There's a lower chance of a rate cut, but it's still good because it means the US economy is not in a free fall. What were those numbers? Well, we just got the numbers of the initial jobless claims. What is the initial jobless claims? So that's how many people are claiming benefits in the US. They're claiming sort of unemployment money. We were expecting 220,000 people to claim it, but actually there's less people claiming it, which basically means there's less people unemployed. There's 191,000 people claimed it, meaning we're looking at less people losing their jobs. That was less than expected. If that number was 250,000 or 300,000, the chance of a rate cut would skyrocket, and also the people would start calling for a recession. We actually got 191,000, which is a bit stronger, meaning the US market is a bit stronger. What does that mean in terms of rate cut? We're still going to get a rate cut. We still have priced in it's dropped about 1 percentage point. We're still pricing about a 90% chance of a rate cut next week. But the big question is what happens after? Because after this one rate cut, which everyone around the world agrees on, whether you're Jerome Powell or Hassett, who really wants to cut rates, or President Trump, everyone agrees on this rate cut. However, next year is when we get the big disagreements. Some people say we need no more rate cuts. Some people say we need 2 more percent worth of rate cuts. Some people say we need 0.5% worth of more rate cuts. Next year is going to be absolute turmoil because no one will be able to agree on the fact whether they should have rate cuts or not. And then we're going to get a new Fed chair, and then we're going to have issues of Hassett. Then we're going to have potentially more rate cuts, but also mortgage rates going up. So next year could be a very concerning year potentially because of where we are in the market, because getting that final rate is very, very hard. Getting that restrictive rate, remember that they've got 2 mandates: keep inflation under control, but also keep the jobs market under control. Inflation is coming down, jobs are also coming down. So it's very hard, and you need that restrictive rate that keeps inflation under control and keeps the job market and the economy strong. Getting that specific rate is where everyone's going to disagree. Everyone knows it's lower than it is right now. Everyone can agree that the rate should be lower than it is right now, but no one can agree where that base rate is. And that's going to be the whole narrative of next year. It's going to be, what is that restrictive rate and where do we stop cutting rates? And people will disagree. But these figures here, nothing crazy, quite bullish. Economy's good. Inflation's coming down. Rate cut probably next week. But now start looking ahead to 2026. Thank you everyone for tuning in. Make sure you get that newsletter. I'll just tell you about it one more time. This is, if you want to succeed in the markets, you need to know what's going on in the markets. You need to understand the markets. You need to be up to date with the markets. You need to see what's going on every day. But you don't want to do 7 hours of research every day. That's why I do 7 hours of research. There's 2 of us now working on this, about 7 hours of combined research. That's on the daily newsletter to get you ahead. You've got the top stories, the one big thing, all the numbers, all the deep dives, all the charts. You get it all. Plus, you get the XRP weekly newsletter. Plus, you get the training course coming. Plus, you get my portfolio access coming soon. Plus, you get the debt planner and the budget planner. Plus, you get to be part of the community to DM me. But essentially, the outcome is what's important, and the outcome is you'll become a better investor. So I'm going to give you that link. You get a 1-week free trial on the annual plan. It's in the live chat. It's the first link in the description. We're going to go over to Martyn. Martyn has full analysis now for you. He's been covering this as well. So Martyn is live now, I believe. Yeah, Martyn is live now. So we're going to go over to Martyn for his full analysis. Bitcoin is flat. XRP is flat. The S&P 500 is down slightly because the rate cut expectations might be slightly less after today's day. But I'm glad we covered today's data. Very important, especially looking forward. I hope that deep dive really helped you. If you weren't here when we were covering the deep dive, go grab the newsletter, because that deep dive is so important. It shows you why, if you get too many rate cuts, mortgage rates actually go up, and you need to understand that dynamic. Until tomorrow, I'd love to talk to you guys. So start messaging in the newsletter. You can DM me one-on-one as well. But I'll see you all tomorrow. Let's go over to Martyn now. The link is pinned up above. So here is Martyn. I'll give you his link for his stream. But this will automatically take you there as well. If you stay where you are, you'll go over to Martyn. He's got full analysis. He's going to be live for the opening bell. He's live right now on this channel. The link is in the live chat. So is the newsletter link.